Imagine standing in front of a store where everything on the shelf is being sold for far less than it is truly worth. Not because the products are broken or useless, but simply because most shoppers have walked past without bothering to look. The products are dusty, the labels are not glamorous, and the storefront does not have the bright neon glow that draws a crowd. But if you take the time to look inside, if you have the patience and the discipline to reach past the obvious and the fashionable, you will find something extraordinary. You will find real, genuine value sitting quietly on the shelf, waiting for someone wise enough to pick it up. This is not a story about a store. This is the story of the stock market. And more specifically, this is the story of a remarkable idea that Tobias E. Carlisle has spent years researching, testing, refining, and presenting to the world. The idea is called the acquirer's multiple. It is a formula, a mindset, and a philosophy all rolled into one. It is the secret weapon used by some of the most successful, most disciplined, and most contrarian investors who have ever walked through the doors of finance. And it is a strategy that, when followed with patience and consistency, has been shown by decades of rigorous back-tested data to consistently beat the broader market, outperform the so-called magic formula, and generate returns that most everyday investors only dream about. What makes this story even more compelling is not just the numbers, it is the people. It is Warren Buffett, once a scrappy young man picking through financial rubble, like a man looking for half-smoked cigarettes on the street, hunting for one last puff of value before tossing them aside. It is Carl Icahn, the fierce and feared corporate raider who turned the simple act of buying undervalued companies into a career of billions. It is David Einhorn and Dan Loeb, the modern generation of deep value warriors who took old principles and made them fresh again in the 21st century. Their stories are the backbone of this book, and they breathe life into ideas that could otherwise feel cold and abstract on the page. But before we meet those legends, we must first understand the world they chose to enter. We must understand why most investors lose, why the crowd almost always gets it wrong, and why the uncomfortable and the overlooked almost always hold the greatest reward. That journey begins right now, in the very first chapter of this extraordinary book. Hold on tight. This will change the way you think about money forever. Chapter 1. How the Billionaire Contrarians Invest. To understand why the acquirer's multiple works, you must first understand the mindset of the people who use it. These are not ordinary investors. They do not follow headlines. They do not chase the stocks that are climbing fastest or buying the companies that everyone else is talking about at dinner parties. They do something altogether different, and at first glance, something that seems almost counterintuitive. They go looking for the stocks that nobody wants. They seek out the companies that are struggling, unloved, undervalued, and ignored. They walk into the burning building while everyone else is running out. And they do it, not out of recklessness, but out of deep, rigorous, data-driven confidence. The term that Carlisle uses to describe this approach is deep value investing. It is a strategy rooted in one foundational belief, that the market, from time to time, dramatically misprices certain companies, not by a small margin, not by a percentage point or two, but by truly significant amounts, sometimes pricing a business at less than what a rational buyer could purchase the entire thing for and immediately turn a profit. When that happens, the deep value investor strikes, not with excitement or emotion, but with calm, calculated precision. The contrarian nature of this approach is what makes it both powerful and psychologically difficult. When you buy a stock that is beaten down, when you purchase shares of a company that everyone else has abandoned, you are going against the crowd. You are placing your bet on something that feels wrong, uncomfortable, and uncertain. This discomfort, Carlisle argues, is not a flaw in the strategy. It is actually the source of the strategy's power, because if buying deeply undervalued stocks felt easy and comfortable, everyone would do it. And if everyone did it, those stocks would not be undervalued anymore. The very difficulty of buying ugly, beaten-down businesses is precisely what keeps the opportunity alive. Carlisle draws heavily on the concept of mean reversion to explain why this works. Mean reversion is the powerful statistical tendency for things to return to their average over time. A company that is earning far below its historical average will, in most cases, eventually recover and return to something resembling normal profitability. A company that is trading at an extremely low price relative to its earnings will, in most cases, eventually see that price rise back toward a more reasonable level. This is not guaranteed. Not every company recovers. But when you build a portfolio of many such companies, spread across many different industries and sectors, the law of averages begins to work powerfully in your favor. The billionaire contrarians profiled in this book understood this instinctively. They knew that markets were not perfectly rational. They knew that fear and panic and short-term thinking caused the crowd to make predictable, repeated mistakes. And they positioned themselves to profit from those mistakes by doing the opposite of what the crowd was doing. They zigged when others zagged. They bought when others sold. They held when others fled. And the results, over long periods of time, were extraordinary. The acquirer's multiple is Carlisle's attempt to bottle that wisdom, to distill it into a single formula that any investor can use, and to prove, with decades of historical data, that it actually works. The journey to that formula is the story this book tells, and it begins with the man who is arguably the greatest investor who has ever lived, Warren Buffett. Chapter 2. How Warren Buffett Got Started. Warren Buffett did not begin his career as the warm, grandfatherly figure who talks about buying wonderful businesses and holding them forever. That version of Buffett came later, shaped by decades of experience and, crucially, by the influence of his legendary partner, Charlie Munger. The early Buffett was something quite different. He was a hunter, a scavenger of financial wreckage, a man who looked through financial statements the way a surgeon looks through an X-ray, searching for the hidden truth beneath the surface. Buffett's early investment philosophy was inherited almost entirely from his mentor, Benjamin Graham. Graham was a professor, a theorist, and a practitioner who had lived through the great crash of 1929 and watched fortunes evaporate overnight. That experience shaped his investment philosophy in a profound and enduring way. Graham became obsessed with the idea of safety, with finding companies that were so cheap, so obviously undervalued, that the very act of buying them contained within it a built-in cushion against loss. He called this the margin of safety, and it became one of the most important concepts in all of investing. Graham's most extreme form of value hunting was something he called the net-net strategy. The idea was simple in principle, but demanding in execution. You would look for companies where the total current assets of the business, meaning cash, receivables, and inventory, minus all of the company's total liabilities, exceeded the market price of the entire company. In other words, you would be paying less for the company than it would be worth if you simply shut it down and sold off all its liquid assets today. You were buying the business for less than nothing. You were getting the operating company for free as a bonus on top of the underlying asset value. This was the strategy that the young Warren Buffett adopted with great enthusiasm. He would go through financial reports page by page, company by company, looking for these so-called cigar butt stocks. The name comes from the image of finding a half-smoked cigar on the street. Most people would not pick it up. It is not glamorous. It is not attractive, but it still has one or two puffs left in it, and for someone disciplined enough to pick it up, that last puff is free. It costs nothing. The value is already there, discarded by someone else. Buffett was extraordinarily good at finding these cigar butts. He was relentless in his research, tireless in his analysis, and deeply rational in his decision-making. He ran a series of investment partnerships during the 1950s and 1960s that produced annual returns that were almost unimaginable by any standard. He consistently and dramatically outperformed the broader market, year after year, using this deep value approach that Graham had taught him. He bought companies that were out of favor, ignored, and misunderstood, and he waited patiently for the market to recognize the value he had already seen. And it worked, over and over again. But then, something began to change. As Buffett's capital grew, the universe of tiny, beaten-down cigar butt stocks became too small for him to operate inefficiently. You cannot build a multi-billion-dollar portfolio from stocks that trade only a few $1,000s worth of shares each day. The scale of his success began to work against the very strategy that had created it. And this is where Charlie Munger entered the picture and changed everything. Munger pushed Buffett to think differently about quality. He argued that it was not enough to simply buy cheap businesses. He argued that buying a truly exceptional business, one with durable competitive advantages, loyal customers, pricing power, and high returns on invested capital, was worth paying a higher price. The philosophy shifted from buying ugly businesses at wonderful prices to buying wonderful businesses at fair prices. And while this shift served Buffett extraordinarily well as his capital grew, Carlisle argues in this book that the original, earlier approach was actually the more powerful one, at least for investors working with modest sums. The story of why that is true is the heart of everything that follows. Chapter 3: The History of Activist Hedge Funds. The story of deep value investing cannot be told without understanding one of its most aggressive and consequential expressions: activist investing. An activist investor is not content simply to buy shares of an undervalued company and wait. The activist takes things a step further. The activist buys a significant stake in the company and then uses that stake to demand change, to pressure management, to argue publicly that the company is being mismanaged, that its assets are being squandered, and that shareholders deserve better. The activist is, in the most fundamental sense, a catalyst for value unlocking. This approach has a long and colorful history, filled with fierce battles, dramatic confrontations, and enormous profits. It grew out of the same soil that nurtured deep value investing, the realization that certain companies were trading for dramatically less than they were actually worth, and that patient ownership was one way to profit from that mispricing, but that active intervention was another and sometimes faster way. The history of activist hedge funds is closely intertwined with the era of corporate raiders in the 1970s and 80s. These were investors who would identify underperforming or undervalued companies, acquire large stakes in them, and then push for dramatic changes. Sometimes, those changes involved breaking up the company and selling its parts for more than the whole was worth. Sometimes, it involved replacing management. Sometimes, it involved financial restructuring, taking on debt to pay out large dividends, or spinning off subsidiaries that were being dragged down by the parent company's poor reputation. The corporate raiders were controversial figures. They were vilified in popular culture, portrayed as ruthless destroyers of companies and jobs, men who cared only about short-term profits at the expense of workers and communities. The movie Wall Street, with its iconic character Gordon Gekko proclaiming that greed is good, was in many ways a commentary on this era. But the reality was more nuanced. While some raiders certainly engaged in destructive behavior, many of them were genuinely identifying companies that were wasting capital on a massive scale. Companies where entrenched and incompetent management was destroying shareholder value year after year and forcing the kind of accountability that the market, left to itself, was too slow to provide. Tobias Carlisle traces how the corporate raider era evolved into the more institutionally sophisticated world of modern activist hedge funds. Over time, the brute force takeover approach gave way to a more strategic, legally refined form of activism. Rather than launching hostile tender offers, modern activists would accumulate stakes quietly, then make their case publicly, sometimes through letters to the board, sometimes through proxy battles to elect new directors, sometimes through direct negotiation with management behind closed doors. The tools changed, but the underlying logic remained identical. Find a company where the market has underpriced the value, and then do something about it. What is particularly important for the purposes of this book is the way activist investing reinforces the core thesis of the acquirer's multiple. Both approaches start from the same place, the identification of companies that are trading below their intrinsic value. The activist investor then tries to speed up the process of value realization by forcing change from within. The passive deep value investor, the one following the acquirer's multiple, simply trusts that mean reversion and the forces of the market will eventually do the job on their own. Both approaches, when based on rigorous identification of genuinely undervalued companies, have historically produced exceptional returns. The activists and the passive deep value investors are, in many ways, different branches of the same family tree. Chapter 4: How to Beat the Little Book That Beats the Market. In 2005, a hedge fund manager and adjunct professor named Joel Greenblatt published a slender, accessible book that would become one of the most influential investing texts of the modern era. The book was called The Little Book That Beats the Market, and its central idea was something Greenblatt called the magic formula. The magic formula was deceptively simple. It ranked stocks on two criteria. The first was how cheap they were, measured by dividing a company's earnings before interest and taxes, or what is commonly called EBIT, by its enterprise value, which is essentially the total cost of buying the entire business, including its debt. The second criteria was how good the business was, measured by its return on invested capital, which tells you how efficiently the business is turning its investment into profit. You would rank every stock on each of these two measures, add the rankings together, and then buy the top 30 or so names on the combined list. The formula was saying, buy cheap, good businesses. Greenblatt backtested this approach over many years and found results that were genuinely stunning. The magic formula had historically produced annual returns dramatically above what the broader market delivered. It was simple. It was systematic. It removed emotion from the investment process, and it worked. The book became a phenomenon, introducing a generation of investors to the idea of quantitative, systematic value investing. But Carlisle, digging deeper into the data, found something that Greenblatt had not fully explored. He began to question one of the two components of the magic formula. Specifically, he began to question the quality component, the return on invested capital piece. The question he asked was this: does including a quality filter actually improve returns, or does it actually reduce them? The answer he found was both surprising and illuminating. Because of mean reversion, companies with very high returns on invested capital today tend not to maintain those high returns over time. Competition enters the market. Rivals copy their products. The advantages that generated those high returns erode over time. The profits mean revert back toward average. So when you select stocks based partly on how profitable they currently are, you are, in effect, selecting companies that are at or near the peak of their profitability cycle, and buying things at their peak is almost never a good strategy. When Carlisle stripped away the quality component and kept only the cheapness component, the pure enterprise value to operating earnings ratio, he found that the remaining formula actually outperformed the full magic formula. Not by a little. By a meaningful, statistically significant margin, tested across decades of historical data. The acquirer's multiple, which is simply enterprise value divided by operating earnings, beaten the magic formula that uses two screens by focusing on just one, but the right one. This finding is central to the entire book. It tells us that cheap beats good. It tells us that the market, despite its intelligence and its collective wisdom, consistently and repeatedly overestimates the durability of quality and underestimates the power of cheapness. And it is the key insight that unlocks the rest of everything Carlisle has to say. Chapter 5. A Simple Way to Value Stocks. The Acquirer's Multiple. Now we arrive at the heart of the book, the formula itself, explained in careful and accessible detail. The acquirer's multiple is built on a specific way of thinking about what it truly costs to buy a business. Most casual investors look at the stock price and the market capitalization, which is simply the stock price multiplied by the number of shares outstanding. But Carlisle argues that this is an incomplete and often misleading way to measure the value of a business. The reason is that it ignores something crucially important: debt. When you buy a company, you are not just buying its equity, you are inheriting its debt. If a company has $100 million in market capitalization, but also has $200 million in debt, the true cost of owning that company is $300 million, not $100 million. You would need to pay off that debt once you took control. Conversely, if a company has $100 million in market capitalization and no debt, but holds $50 million in cash, the true cost is only $50 million, because you can immediately use that cash once you own the company. The metric that captures this true total cost is called enterprise value. Enterprise value is calculated by taking the market capitalization of a company, adding all of its debt and any preferred stock obligations, subtracting any cash and short-term investments it holds, and then adding any minority interest. It is, in essence, what an acquirer, a company, or investor looking to buy the whole business would actually need to pay in total. This is where the name of the formula comes from. The acquirer's multiple asks the question that an actual acquirer would ask: what is this business truly costing me, and how does that compare to what it actually earns? The earnings measure Carlisle uses is operating earnings, also sometimes described as a form of earnings before interest and taxes, but adjusted to remove the distortions that accounting choices can introduce. This measure focuses on what the business actually earns from its core operations, before the effects of how it is financed, before taxes that can vary widely between companies and countries, and before depreciation and amortization charges that can sometimes obscure true operating performance. When you divide enterprise value by operating earnings, you get the acquirer's multiple. A lower number is better. A company with an acquirer's multiple of 5 is saying that the total cost of buying the business is only 5 times what it earns in a single year from its operations. That is cheap. A company with an acquirer's multiple of 30 is saying you would need to wait 30 years of full operating earnings to recoup your purchase price. That is expensive. The strategy is brutally simple. Rank every stock by its acquirer's multiple. Buy the lowest ranked ones, meaning the cheapest ones, hold them for a year, and then repeat. This is not glamorous. The companies on the cheapest end of the acquirer's multiple list are almost never exciting. They are often in unfashionable industries. They often have ugly recent histories, perhaps a product recall, a regulatory setback, a bad earnings quarter, a change in leadership. They are the stocks that financial journalists are writing negative articles about. They are the stocks that your friends are not talking about. They are the stocks that feel uncomfortable to buy. And that, as Carlisle repeatedly reminds us, is precisely the point. The discomfort is the premium you earn for being willing to do what others are not. The price of the return is the willingness to sit with the ugly and the unloved and the misunderstood. Carlisle's research, conducted across more than 4 decades of stock market data, shows that buying the cheapest decile of stocks by the acquirer's multiple, meaning the 10% of stocks that are cheapest on this metric, has historically produced annual returns of around 17.9%. That is dramatically higher than the broader market's long-term average of roughly 10% annually. And it is achieved not through genius stock picking, not through superior access to information, not through inside knowledge, but through simple, systematic, disciplined adherence to a single formula that anyone can apply. Chapter 6. The Secret to Beating the Market. The secret, when you strip away all the complexity and all the jargon, is deeply rooted in one concept: mean reversion. Carlisle dedicates considerable attention in this chapter to explaining not just what mean reversion is, but why it is so powerful, so reliable, and so consistently misunderstood by the investing public. Mean reversion is the tendency for things that have moved far away from their historical average to eventually move back toward that average. This is true in nature. A child born to two unusually tall parents will, on average, be shorter than those parents. Extreme outcomes tend to moderate over time, returning to what is normal and expected. The same principle applies in business and in markets, but with a crucial twist. Markets are made up of human beings, and human beings are terrible at intuitively accounting for mean reversion. When a company is doing extremely well, when its profit margins are high, its growth is rapid, and its stock is rising, investors project those conditions forward indefinitely. They assume the good times will continue. They buy the stock at high prices, reflecting an expectation of continued excellence. But mean reversion is quietly working against them. Competition, market saturation, management errors, technological change, and 100 other forces are constantly eroding the advantages that produce those exceptional results. The high profits attract competitors who gradually chip away at the margins. Over time, the extraordinary becomes ordinary. The stock, bought at a high price on the assumption of continued excellence, disappoints. The opposite happens with deeply undervalued companies. When a company is struggling, when its earnings are depressed, its stock is falling, and the financial press is writing negative stories about it, investors project those bad conditions forward. They assume the company is heading toward failure. They sell the stock at low prices, reflecting an expectation of continued deterioration. But here, too, mean reversion is quietly at work. Many of these companies, though troubled, are not headed toward extinction. They still have real assets, real customers, real revenues. The conditions that depress their earnings are temporary. Management changes, cost-cutting, asset sales, improved market conditions, or simply the passage of time can all contribute to a recovery. And when recovery comes, the stock bought at depressed prices delivers exceptional returns. This is the engine that powers the acquirer's multiple. It is not magic. It is not some exotic financial alchemy. It is the simple, powerful, mathematically grounded reality that extreme conditions tend not to persist, and that markets, driven by emotional human beings, consistently overreact to both good news and bad news. The deep value investor, armed with this understanding, deliberately positions a portfolio to benefit from the return to normalcy. The key is not predicting which individual company will recover. The key is buying a diversified basket of deeply undervalued companies and trusting that, across the portfolio, mean reversion will do its work. Some companies will not recover. Some will fail. But the ones that recover will recover so dramatically that they more than compensate for the losses on the ones that do not. Carlisle is careful to address the psychological challenge this creates. Waiting for mean reversion to occur is not easy. It can take months. It can take years. During that time, the stocks you hold may continue to fall. The news about the companies you own may continue to be negative. Your friends, your colleagues, perhaps even your spouse, may tell you that you are making a terrible mistake. The patience required to stay the course, to trust the data and the process in the face of short-term discomfort, is the real barrier to success. This is why the strategy, despite being publicly available and well documented, does not get arbitraged away. The human mind is simply not built to handle the psychological pressure of holding deeply undervalued, deeply unloved stocks over long periods of time. Those who can train themselves to withstand that pressure, who can hold their position when it feels most wrong, are the ones who eventually collect the extraordinary returns that the strategy promises. Chapter 7. How Carl Icahn Got Started. Carl Icahn is one of the most feared, most studied, and most imitated investors of the past half-century. His story is one of extraordinary ambition, relentless aggression, and a deep, almost instinctive understanding of how to extract value from situations that other people had given up on. And in many ways, his career is a living, breathing embodiment of the principles at the heart of the acquirer's multiple. Icahn was born in 1936 and grew up in modest circumstances. He was intellectually gifted, eventually attending Princeton University on a scholarship, where he studied philosophy before switching to a pre-medical track and eventually abandoning formal academic pursuits to pursue Wall Street. He started his career as a broker and options trader in the 1960s, slowly building his capital and developing his investment philosophy. The crucial moment in Icahn's evolution as an investor came in 1976, when he crafted what became known as the Icahn Manifesto. This was a document he sent to potential investors in his new fund, outlining a strategy that was, at its core, a formalized version of deep value activism. The manifesto laid out a remarkably clear and honest description of the opportunity Icahn had identified. He observed that many publicly traded companies were trading for dramatically less than they would be worth if they were simply sold, broken up, or restructured. He further observed that most investors and most other financial institutions were reluctant to do anything about this mispricing, either because they lacked the capital, the legal expertise, or the stomach for the fight that would be required to force change. Icahn had all three. He had the capital, he had the legal and financial knowledge, and he absolutely had the stomach for a fight. He began acquiring large stakes in undervalued companies and then using those stakes to demand change from management. He was relentless, creative, and utterly fearless. He would wage proxy battles to replace board members. He would make hostile tender offers. He would write scathing public letters. He would litigate aggressively. He understood that the very act of starting a fight, even before winning it, tended to produce results, because target companies facing serious pressure would often seek out a so-called white knight, a friendly acquirer willing to pay a higher price to rescue them from Icahn's clutches. This bidding dynamic created enormous profits for Icahn, even in situations where he never fully intended to complete a takeover. What is fascinating about Icahn's approach, from the perspective of this book, is that it was built entirely on the same foundation that the acquirer's multiple uses. Every Icahn campaign began with the same starting point, the identification of a company that was trading for significantly less than its intrinsic value. The activism was the catalyst that sped up the recognition of that value. But the value had to be there first. Icahn was not creating value out of nothing. He was finding value that already existed and forcing the market to recognize it. This is the deep value investor's core mission, whether you are Icahn with billions of dollars and an army of lawyers, or you are an individual investor following a simple formula and buying a basket of undervalued stocks. The difference is method. The foundation is identical. Carlisle presents Icahn's career not just as a biographical curiosity, but as a proof of concept. Icahn's ability to identify deeply undervalued companies and profit from their recovery, whether through activism or simply through the passage of time, is one of the longest and most compelling track records in the history of investing. He earned returns that made him a billionaire many times over. And he did it by doing what most people found too uncomfortable, too confrontational, and too risky. He bought the ugly. He bought the unloved. He bought the hated. And he made a fortune. Chapter 8. How David Einhorn and Dan Loeb Got Started. The generation of deep value investors that followed in the footsteps of Icahn brought with them a somewhat different set of tools, but an identical set of underlying principles. David Einhorn and Dan Loeb represent two of the most prominent and successful examples of this new generation, and their stories illuminate how the deep value tradition has evolved and adapted to the complexities of modern financial markets. David Einhorn founded Greenlight Capital in 1996 with an amount of capital that, by the standards of Wall Street, was extremely modest. He had the discipline to do exhaustive fundamental research on companies he believed were mispriced, and the courage to act on his conclusions even when they were deeply unfashionable. Einhorn became particularly famous for his willingness to take short positions in companies he believed were overvalued or were engaging in accounting irregularities. His presentation at a financial conference in 2008, in which he publicly argued that Lehman Brothers was concealing the true extent of its problems, became one of the most dramatic and consequential moments in recent financial history. Lehman collapsed shortly thereafter. Einhorn's courage to publicly take a position that contradicted the conventional wisdom proved to be both financially rewarding and professionally defining. But Einhorn was equally known for his long positions in deeply undervalued companies. His process, like all great deep value investors, began with a willingness to look at companies that the market had given up on, to study them carefully, to understand what the market was missing, and to have the conviction to invest when others were fleeing. His returns over his career have been, over the periods in which his original methodology was fully applied, consistently exceptional. Dan Loeb founded Third Point Capital and developed a distinctive style that combined deep value analysis with a particularly colorful and aggressive form of activism. Loeb became legendary for his shareholder letters, which were frequently scathing, sometimes almost brutally personal in their criticism of management, and always meticulously researched and argued. He would identify a deeply undervalued company, build a stake in it, and then write publicly about exactly why he believed the company was being mismanaged and what changes he believed were needed to unlock the value he saw. His letters were must-reads in financial circles, feared by management teams, and admired by investors who appreciated the combination of rigorous analysis and unabashed directness. What both Einhorn and Loeb share with each other and with their predecessors, like Buffett and Icahn, is the fundamental starting point, the identification of companies that are trading for substantially less than their intrinsic value. All of the activism, all of the shorting, all of the letter writing and public confrontation is built on top of that foundation. Remove the rigorous value analysis, and the whole structure collapses. It is the valuation discipline, the patient hunting for genuine cheapness, that makes everything else possible. Carlisle presents their stories as further evidence that the deep value approach, whether pursued passively through a formula or actively through direct engagement with management, is the single most consistently effective investment philosophy that history has produced. Chapter 9: The 9 Rules of Deep Value. After laying the philosophical and historical foundations in the preceding chapters, Carlisle arrives at one of the most practically useful and densely informative sections of the entire book, the 9 Rules of Deep Value. These rules are not abstract principles. They are specific, actionable guidelines that translate the philosophy of deep value investing into a concrete, repeatable investment process. Each rule addresses a specific dimension of the investment process, and together they form a comprehensive framework for identifying, evaluating, and managing a portfolio of deeply undervalued stocks. The first rule is to use the acquirer's multiple as your primary screening tool. As has been explained in detail throughout the preceding chapters, this means calculating enterprise value divided by operating earnings for every stock in your investable universe and ranking them from cheapest to most expensive. You focus your attention on the cheapest decile, the 10% of stocks with the lowest acquirer's multiple scores. This is where the expected returns are highest, and this is where you begin your search. The second rule is to look for a margin of safety. This concept, borrowed directly from Benjamin Graham, means that you should not simply buy any company that appears cheap on the acquirer's multiple. You should look for companies where the cheapness is accompanied by some additional form of protection against permanent loss. This might come from the balance sheet, specifically a company that carries low debt relative to its assets or cash, reducing the risk that financial distress could destroy the value you are counting on recovering. It might come from the nature of the business itself, a company with real, tangible assets, a real operating history, and no signs of accounting manipulation or fraud. The third rule is to avoid financial stocks and utilities when applying the formula. This is a practical adjustment rather than a philosophical one. Financial companies like banks and insurance companies have balance sheets that work fundamentally differently from those of ordinary industrial or commercial businesses. Debt, for a bank, is not a burden in the same way it is for a manufacturing company. It is, in fact, the raw material of the business. Applying the standard enterprise value calculation to a financial company produces meaningless results. Similarly, regulated utilities operate under constraints that make their financial metrics incomparable to unregulated businesses. Excluding these sectors preserves the integrity of the screening process. The fourth rule is to be systematic and disciplined. This is perhaps the hardest rule to follow, not because it is intellectually difficult, but because it runs directly against the grain of how most people are psychologically wired. When you buy a basket of deeply undervalued stocks, and one of them begins to fall further, the natural impulse is to sell it to stop the pain. When a stock in your portfolio is rising nicely, the natural impulse is to sell it to lock in the gain. The systematic approach demands that you resist both impulses. You buy according to the formula. You hold for the prescribed period, typically 1 year. You sell when the year is up, and the stock no longer qualifies as cheap by the formula's standards. You do not deviate from the process because of how you feel. Consistency is the engine of the strategy's long-term performance. The fifth rule is to diversify broadly. The deep value strategy works best when applied across a large number of positions, typically at least 20 and ideally 30 or more. This is because, at the individual company level, the outcome is highly uncertain. Any one company in your portfolio might fail to recover, but across a portfolio of many companies, the law of large numbers begins to work in your favor, and the mean reversion tendencies that the strategy depends on become statistically reliable. Concentration in a small number of deep value picks amplifies idiosyncratic risk, meaning the risk specific to each individual company, without providing a corresponding increase in expected return. The sixth rule is to be patient. The time frame for mean reversion to occur is measured not in days or weeks, but in months and years. A deep value stock may continue to decline for 6 months or a year after you buy it, before the forces of recovery begin to take hold. The investor who sells in frustration after a few months of underperformance has merely transferred their potential return to someone else, the person patient enough to hold the position while the recovery unfolds. One of the most powerful and counterintuitive findings in deep value research is that the stocks that have performed most poorly over the past year tend to perform best over the following year. Patience, in this context, is not merely a virtue. It is a prerequisite for capturing the returns the strategy promises. The seventh rule is to be contrarian. This rule is in some ways the master rule, the one from which all others flow. Being contrarian does not mean simply doing the opposite of the crowd for its own sake. It means having the intellectual independence to look at a company that the crowd has given up on, to analyze it rigorously, and to buy it when the data supports the purchase, even though everything about the emotional environment is screaming that you are making a terrible mistake. The crowd's fear is your opportunity. The crowd's despair is your discount. The crowd's certainty of disaster is your margin of safety. The eighth rule is to focus on the quality of the business enough to avoid outright fraud and financial distress, but not so much that it begins to interfere with the cheapness filter. This is a nuanced balance. You are not looking for wonderful businesses. You are looking for fair businesses at wonderful prices. The business does not need to have extraordinary competitive advantages. It does not need to have a famous brand or a commanding market position. It simply needs to be a real, operating business with genuine revenues and genuine earnings, not one that is headed toward bankruptcy or that is manipulating its financial statements to conceal fundamental problems. The ninth rule is to rebalance annually. Once per year, you look at your portfolio and compare it against the current universe of deeply undervalued stocks. Stocks that have risen in price and are no longer in the cheapest decile are sold because they have fulfilled their purpose. The recovery that you waited for has occurred, and it is time to redeploy that capital into new positions that are now the cheapest available. This annual rebalancing maintains the integrity of the strategy and ensures that you are always buying the cheapest available stocks rather than holding yesterday's bargains that have become today's fairly valued companies. Together, these 9 rules form a complete and coherent investment philosophy. They are not a guarantee of success in any given year. There will be years when the strategy underperforms dramatically. There will be periods when the cheapest stocks continue to get cheaper and your portfolio shrinks painfully. But over the full cycle of a market, over periods of 5, 10, and especially 20 or more years, these rules, applied with discipline and consistency, have produced returns that are dramatically superior to the broader market. This is not a theory. It is a documented, data-driven historical reality. Chapter 10. The Case Against Wonderful Companies at Fair Prices. One of the most provocative arguments in the entire book is the direct challenge Carlyle mounts against the philosophy most closely associated with Warren Buffett's later career. The idea that the best investment strategy is to buy wonderful companies at fair prices. This is the philosophy that produced Berkshire Hathaway's extraordinary record. It is the philosophy that made Buffett the most celebrated investor of the modern era. And Carlyle, with great respect and great care, argues that for most investors, it is actually the less effective approach. The core of Carlyle's argument rests on the concept of mean reversion, which by this point in the book is familiar territory. The challenge with buying wonderful businesses, Carlyle argues, is that identifying which businesses are truly wonderful, meaning which businesses possess durable competitive advantages that can resist the eroding forces of competition and mean reversion, is extraordinarily difficult. Most businesses that appear wonderful today will not be wonderful tomorrow. Their high returns on invested capital will attract competitors. Their pricing power will erode. Their dominant market positions will be challenged by new technologies or new business models. The history of business is littered with companies that appeared for a decade or two to be indestructible and then found themselves obsolete. The risk in following Buffett's later philosophy is that you end up buying what appears to be a wonderful business, but is actually a business at the peak of its quality cycle. You pay a high price, reflecting an expectation of continued excellence, and then mean reversion occurs, not in the direction of recovery, as the deep value investor hopes for, but in the direction of decline, which is the deep value investor's worst enemy. You have paid a premium for quality that does not persist. Carlyle introduces a thought experiment he calls the Poor Charlie, named with affectionate humor after Charlie Munger, Buffett's partner, and the man most responsible for shifting Buffett toward quality investing. The Poor Charlie portfolio is constructed by doing the exact opposite of the quality filter. Instead of buying high-quality businesses at reasonable prices, it buys the cheapest businesses regardless of their quality, measured purely by the acquirer's multiple. The data shows that this approach, which is the purest distillation of deep value investing, actually outperforms the quality-focused approach over long historical periods. This does not mean that Buffett has been wrong. Buffett's genius lies not just in his investment methodology, but in his ability to correctly identify the rare companies that genuinely do resist mean reversion, the ones with moats so deep and competitive advantages so durable that they can sustain above-average profitability for decades. He is, by any measure, extraordinarily gifted at this task. But the argument Carlisle makes is that most investors are not Warren Buffett. Most investors are not able to reliably distinguish between a business with a genuinely durable competitive advantage and a business that merely appears to have one. For those investors, the systematic, formula-driven approach of the acquirer's multiple, which requires no judgment about business quality and relies entirely on price discipline, offers a more reliably achievable path to superior returns. Chapter 11. The Power of Enterprise Value over Market Capitalization. A critical and often underappreciated aspect of the acquirer's multiple is its use of enterprise value rather than market capitalization as the measure of a company's price. Carlisle devotes significant attention to explaining precisely why this distinction matters so much, and the explanation reveals a deep truth about how companies should be valued. Market capitalization is the most commonly used price metric in investing. It is calculated simply by multiplying the stock price by the number of shares outstanding, giving you the total market value of the equity in a company. This number is everywhere. It is how the financial press describes company sizes. It is how most valuation ratios, including the ubiquitous price-to-earnings ratio, are constructed. And it is, Carlisle argues, profoundly inadequate as a measure of what a business truly costs to own. The inadequacy arises from what market capitalization ignores: the capital structure of the business. Two companies can have identical market capitalizations, but wildly different true costs. Imagine two companies, each with a market capitalization of $500 million. Company A has no debt and holds $100 million in cash. Company B has $300 million in debt and no cash. To acquire Company A entirely, you would need to pay $500 million for the equity and then receive the $100 million in cash, for a net cost of $400 million. To acquire Company B entirely, you would need to pay $500 million for the equity and then immediately pay off $300 million in debt, for a total cost of $800 million. Same market capitalization, wildly different true cost. Enterprise value captures this true cost. It incorporates the debt, the cash, and other capital structure considerations to give you a number that represents what a rational buyer would actually need to pay to own the entire business. This is precisely the perspective of a corporate acquirer, hence the name of the formula. When you are thinking about valuing a business, you should always be thinking in acquirer terms, not just what the equity costs, but what the whole enterprise, debt and all, would cost to own and operate. This is why the acquirer's multiple is a more accurate and more powerful valuation tool than the price-to-earnings ratio or other market capitalization-based metrics. It accounts for the full picture. It penalizes companies that are carrying heavy debt loads by making them appear more expensive in the formula. It rewards companies that are debt-free and cash-rich by making them appear cheaper. These adjustments are not mere technical refinements. They are fundamental to the accuracy of the valuation, and they directly affect which companies end up on the most attractive end of the ranking. Historical research has consistently shown that enterprise value-based metrics outperform market capitalization-based metrics as predictors of future stock returns. The reason is straightforward. Enterprise value-based metrics more accurately measure the true price of the business, and it is the relationship between true price and true earnings that drives investment returns. The acquirer's multiple, by using enterprise value in the numerator and a clean measure of operating earnings in the denominator, achieves a level of precision in measuring value that simpler ratios simply cannot match. Chapter 12. Behavioral Finance and Why Investors Keep Getting It Wrong. One of the most fascinating threads running through the acquirer's multiple is the question of why the opportunity exists in the first place. If buying deeply undervalued stocks consistently generates superior returns, and if this fact has been documented in academic and practical research for decades, why does the opportunity not simply get arbitraged away? Why do deeply undervalued stocks continue to exist? Why do investors continue to make the same predictable mistakes? The answer lies in the field of behavioral finance, which studies the systematic psychological biases and errors that affect human decision-making in financial contexts. Carlisle weaves insights from behavioral finance throughout the book, using them to explain both the persistence of the deep value opportunity and the psychological difficulty of actually capturing it. The most fundamental behavioral error that creates deep value opportunities is what psychologists call the representativeness heuristic. This is the human tendency to judge the likelihood of future outcomes based on how similar they are to recent experiences. A company that has recently had poor earnings, negative press, and a falling stock price looks like a company that will continue to have poor earnings, negative press, and a falling stock price. It feels representative of failure. And so, investors sell it or avoid it, pushing the price down to levels that are dramatically below its intrinsic value. Conversely, a company with recent strong earnings, positive press, and a rising stock price looks like a company that will continue to thrive. It feels representative of success. And so, investors buy it enthusiastically, pushing the price up to levels that price in many years of continued excellence, levels that are vulnerable to disappointment when mean reversion inevitably begins. This behavioral pattern is deeply ingrained and extremely difficult to override. The deep value investor must constantly fight against the emotional pull of representativeness. Buying a company that feels like a failure requires an act of deliberate rational override. You must convince yourself that the data, not the feeling, is the reliable guide. This is hard. It requires training. It requires experience. It requires, above all, a profound trust in the long-run power of the process over the short-run noise of the emotions. Another critical behavioral factor is what is called loss aversion, the well-documented human tendency to feel the pain of losses more acutely than the pleasure of equivalent gains. Because deep value stocks are often in the process of declining when you buy them, the short-term experience of holding them is often one of losses. This pain is psychologically disproportionate to its actual financial significance, but it feels very real and very immediate. Loss aversion pushes investors to sell their deep value holdings prematurely before mean reversion has had time to do its work. The investor who can genuinely feel indifferent to short-term paper losses, who can look at a portfolio that is down 20% and remain calmly committed to the process, is enormously advantaged over the investor who is tortured by that same 20% decline and eventually sells in frustration. Carlisle is remarkably honest about the emotional difficulty of deep value investing. He does not present it as an easy path or a comfortable one. He acknowledges that there will be long periods of underperformance. He acknowledges that the stocks you buy will often continue to look terrible for months or years before they recover. He acknowledges that friends, family, and colleagues will question your sanity. He presents all of this not as a deterrent, but as an honest description of what the strategy demands, and as further evidence of why the opportunity exists and persists. The returns are there because the price of earning them, the psychological price, is real and significant. Only those willing to pay that price fully and consistently will collect the reward. Chapter 13. Building and Managing a Deep Value Portfolio. The final major practical section of the book addresses how to actually construct and manage a portfolio using the acquirer's multiple. Carlisle provides detailed, actionable guidance on the mechanics of implementation, drawing on his own experience as an active value investor and fund manager. The starting point is the construction of the investment universe. You want a broad set of publicly traded companies from which to screen. Carlisle recommends excluding financial companies and utilities for the reasons discussed earlier. You also want to exclude companies with very small market capitalizations if liquidity is a concern, though Carlisle notes that the acquirer's multiple strategy has been shown to work effectively across all market capitalizations, not just in the very small cap space where many value anomalies are traditionally found. The availability of the strategy across company sizes is one of its most practically important features, because it means that investors with significant amounts of capital can use it effectively, not just those working with small sums. Once you have your universe, you calculate the acquirer's multiple for every company in it and rank them from lowest to highest, meaning from cheapest to most expensive. You focus on the cheapest decile, the 10% of companies with the lowest scores. From within that group, you select approximately 30 companies, spread across as many different industries and sectors as possible. Industry diversification is important because it protects against the risk that an entire sector experiences prolonged distress simultaneously. A portfolio of 30 deeply undervalued companies, all from the same industry, is far more vulnerable than a portfolio of 30 deeply undervalued companies spread across many different industries. The position sizing should be roughly equal, with each position representing approximately 1/30th of the total portfolio. This equal weighting approach is deliberate. It reflects the reality that while the formula identifies companies that are collectively likely to outperform, it does not identify which specific companies within that group will be the best performers. Equal weighting ensures that when a big winner emerges, and it will, you have a meaningful position in it, and when a loser fails to recover, you have not been overexposed. The holding period is 1 year. At the end of 1 year, you reassess the entire portfolio. Companies that have appreciated and are no longer in the cheapest decile are sold. Companies that have declined further and have become even cheaper may still qualify for a new position. New companies that have entered the cheapest decile are added. This annual rebalancing maintains the strategy's exposure to the deepest value and ensures you are not holding companies merely because of attachment to your original investment thesis. One of the most important practical points Carlisle makes is about transaction costs and taxes. The annual turnover that the strategy implies, selling positions every year and replacing them with new ones, creates transaction costs and, in jurisdictions where capital gains taxes apply, tax liabilities. These costs are real and must be accounted for when evaluating the net return of the strategy. For investors in tax-advantaged accounts, the impact is minimized. For those investing in taxable accounts, the strategy may need to be adjusted, perhaps extending the holding period or being more selective about which positions to replace to manage the tax drag. For investors who prefer not to manage the mechanics themselves, Carlisle notes that there are index funds and exchange-traded funds that attempt to replicate deep value strategies. He also operates his own investment vehicles through acquirers' funds, which implement the strategy professionally. He is careful to note that professional management introduces its own costs, and that the return to the investor from a managed vehicle will necessarily be somewhat lower than the gross returns the strategy generates before fees. But for investors who lack the time or confidence to manage the strategy themselves, these vehicles represent a reasonable way to access the deep value premium. Chapter 14. Deep Value Across Different Market Conditions. A natural and important question for any investor considering the acquirer's multiple is how the strategy performs across different market environments. Does it work only in particular types of markets? Is it especially vulnerable to crashes or corrections? Does it require a specific set of conditions to generate its superior returns? Carlisle addresses these questions directly, drawing on the breadth of his historical research. The data covers more than 4 decades, a period that includes some of the most dramatic and varied market environments in modern history: the crash of 1973 and 1974, the Great Bull Market of the 1980s, the dot-com bubble and crash, the financial crisis of 2008, and the subsequent recovery. Across all of these very different environments, the deep value approach, based on the acquirer's multiple, has demonstrated consistent outperformance over the full cycle. This does not mean the strategy performs well in every single year. There are periods, sometimes lasting 2 or 3 years, when the strategy materially underperforms the broader market. Often, These are periods of strong economic growth and rising markets. When momentum and growth investing are in favor and cheap, ugly businesses are being left behind. The strategy's underperformance during these periods can be painful, both financially and emotionally. The deep value investor watches while their holdings stagnate or decline, and the fashionable growth stocks that they refuse to buy are soaring. It requires genuine conviction in the process to stay the course during these periods. But the other side of those periods of underperformance is the recovery that follows. When growth stocks eventually disappoint, when the bubble of optimism deflates, when the market begins to recognize the excess valuation that had built up in the fashionable names, the deep value stocks tend to shine. The depressed, ignored companies that the deep value investor has been patiently holding begin to recover. Mean reversion kicks in. Earnings rebound. Acquirers emerge. The stocks that everyone abandoned begin to attract interest again. And the patient investor who held through the dark period collects the return. Carlisle makes a particularly important observation about the strategy's behavior during market crashes. Deep value stocks are already cheap before a crash. They have already been priced as if a worst-case scenario has occurred. When the broader market falls sharply, these deeply discounted stocks often fall less than the market average, simply because they have less optimism priced into them to begin with. And when the market recovers from a crash, the deeply undervalued stocks often recover more dramatically, because they had both the forced selling that accompanies panics and the mean reversion tendency working in their favor simultaneously. This relatively favorable behavior during crashes and recoveries is one of the most practically valuable aspects of the deep value approach for risk-conscious investors. It provides a form of natural downside protection that is not found in growth or momentum strategies, which tend to fall just as dramatically as the market, or more so, when sentiment turns negative. The margin of safety built into the strategy's entry prices does not prevent losses during crashes, but it does provide a cushion that reduces the severity of the losses and accelerates the recovery. Chapter 15. The Importance of Quantitative Discipline. Throughout the book, Carlisle makes a sustained and compelling argument for the superiority of quantitative, rule-based investing over discretionary, judgment-based investing. This argument is rooted not in a theoretical preference for formulas over human judgment, but in the accumulated empirical evidence about how discretionary judgment actually performs when applied to investment decisions. The research is surprisingly consistent and surprisingly unflattering to human judgment. Across a wide range of domains, not just investing, but medicine, law, meteorology, and many others, systematic, rule-based models consistently outperform expert human judgment over large samples. This finding, documented by the psychologist Paul Meehl and many researchers who followed him, is deeply counterintuitive. We tend to believe that expert human judgment, flexible, contextual, capable of recognizing nuance, is superior to simple formulas. The data says otherwise. In investing specifically, the evidence is particularly strong. Fund managers who rely on discretionary judgment consistently underperform simple systematic models over long periods. They are prone to the same behavioral biases that all human beings carry: overconfidence, recency bias, loss aversion, the desire to avoid holding stocks that feel embarrassing. They deviate from the formula when the formula produces results that feel uncomfortable. And that deviation is almost always costly. The quantitative approach that the acquirer's multiple embodies forces the investor to confront these biases directly. By committing in advance to follow the formula, to buy whatever the formula identifies as cheapest, and to hold it for the prescribed period regardless of how it feels, you remove the most dangerous element from the equation: your own emotionally compromised, cognitively limited judgment. You replace it with the accumulated wisdom of decades of historical evidence about what consistently works. This does not mean that all human judgment is worthless in investing. The deep value investor does need to exercise judgment in certain situations. Identifying companies that are fraudulent or that are in the process of genuine and irreversible value destruction requires some degree of qualitative assessment. But Carlisle argues that this judgment should be applied as a filter to remove obvious disasters, not as a tool for active stock selection. The formula does the heavy lifting. Human judgment, used sparingly and carefully, removes the outliers that would otherwise distort the portfolio's performance. The investor who can truly commit to this discipline, who can look at a list of ugly, beaten-down companies generated by a formula and buy them without flinching, without editorializing, without trying to second-guess the model, is the investor who will ultimately collect the returns the strategy promises. The formula is not the enemy of intelligence. It is the expression of intelligence applied correctly, at the strategic level rather than the tactical level, in the form of a commitment to a process that the historical data overwhelmingly supports. Chapter 16. Putting it all together. The Deep Value Investor's Creed. As the book moves toward its conclusion, Carlisle draws together the many threads he has been weaving throughout and synthesizes them into a coherent, actionable philosophy that he calls, implicitly throughout, the creed of the deep value investor. This is not a checklist or a formula. It is a way of thinking about investing, about markets, about human behavior, and about the relationship between patience and reward. The deep value investor believes, first and most fundamentally, that markets are not perfectly efficient. They are made up of human beings who feel fear, who feel greed, who project recent trends into the future, who avoid the uncomfortable, and who chase the exciting. These perfectly human tendencies create predictable, repeatable mispricings that a patient, disciplined investor can exploit systematically over time. The deep value investor believes in mean reversion as one of the most powerful forces in the financial universe. Nothing stays at an extreme forever. The highest flying companies eventually return to earth. The most beaten down companies eventually recover. The investor who positions a portfolio to benefit from the return to normalcy, who buys at the extreme low and waits patiently for the recovery, is aligned with one of the most reliable tendencies in all of financial history. The deep value investor believes in the margin of safety. Every position should be purchased at a price that provides a meaningful cushion against error, against bad luck, against unforeseen events. The margin of safety does not guarantee profit. It limits the downside while preserving substantial upside. It is the investor's acknowledgement that the world is uncertain and that humility about that uncertainty is a form of sophistication, not weakness. The deep value investor believes in diversification, not because it maximizes returns in every individual case, but because it converts an uncertain individual outcome into a reliable statistical expectation across a portfolio. You do not need to predict which company will recover. You need only to ensure that enough of them will, that the law of large numbers will deliver the expected return over time. The deep value investor believes in patience above all else. The willingness to hold through discomfort, to trust the process when the evidence is temporarily pointing the wrong way, to wait for mean reversion to complete its work, is the single most valuable attribute a deep value investor can possess. It is also the rarest. And that rarity is precisely what makes the returns available to those who possess it so extraordinary. The return on patience, in the context of deep value investing, is among the highest available anywhere in the financial world. And finally, the deep value investor believes in the formula. Not blindly, not rigidly, but deeply. The acquirer's multiple is not magic. It is a systematic, evidence-based tool for identifying the kinds of companies that have historically generated superior returns. It is the distillation of decades of research into a single, simple ratio that anyone can calculate and anyone can use. Its power lies not in its complexity, but in its simplicity, and in the discipline required to apply it consistently over time, through the market's good and bad. through the years, comfortable and uncomfortable, through the moments when everything says sell and the formula says hold. Chapter 17. Lessons for the Long-Term Investor. In the final substantial chapter of the book, Carlisle steps back from the mechanics and the history to address the broader lessons that the acquirer's multiple and deep value investing hold for any investor, regardless of their specific approach or strategy. The first, and perhaps most important lesson, is that long-term investing dramatically outperforms short-term trading. The evidence for this is overwhelming and unambiguous. The more frequently investors trade, the more transaction costs they incur, the more taxes they generate, and the more opportunities they create for emotional decision-making to override rational analysis. The deep value approach, with its annual rebalancing and its patient holding periods, is by design a long-term strategy. It is not designed to generate quick profits. It is designed to compound capital over years and decades into substantial wealth. The second lesson is that the primary enemy of good investment returns is the investor themselves. The research on investor behavior consistently shows that actual investors earn significantly lower returns than the funds they invest in because they buy after periods of strong performance, when prices are high, and sell after periods of poor performance, when prices are low. They chase what is working and flee what is not, doing precisely the opposite of what the evidence suggests they should do. The deep value approach, by imposing a systematic discipline that forces you to buy what is cheap regardless of how it feels, directly counters this destructive behavioral pattern. The third lesson is that humility is a competitive advantage in investing. The investor who acknowledges the limits of their own predictive abilities, who recognizes that individual stock picking based on judgment is unlikely to consistently outperform the market, and who responds to that recognition by adopting a systematic, evidence-based approach, is far better positioned for long-term success than the investor who believes in their own superior stock-picking abilities. The history of active fund management is, with a few extraordinary exceptions, a history of underperformance. The humble investor who follows a simple, proven formula will, over time, outperform the majority of professional fund managers, not because the humble investor is more talented, but because the humble investor has made fewer errors, incurred lower costs, and benefited from the consistent application of a strategy that the data supports. The fourth lesson is that the relationship between risk and discomfort is not what most investors intuitively believe. Most investors think that the stocks that feel risky are the stocks that are actually risky. Beaten down, ugly, unloved stocks feel dangerous. They feel like they could go to zero. They feel like something is fundamentally wrong with them. And so most investors avoid them. But the reality, documented across decades of data, is that these deeply undervalued stocks are often far less risky, in the sense of permanent capital loss, than the exciting, fashionable stocks that feel safe and solid because everyone owns them and the financial press speaks positively about them. The true risk is not the discomfort of holding something ugly. The true risk is paying too much for something pretty. The acquirer's multiple, by anchoring every investment decision in rigorous, evidence-based valuation, is fundamentally a tool for managing true risk, even when it involves embracing the kind of emotional discomfort that most investors spend their entire investing lives trying to avoid. The fifth and final lesson is one of genuine optimism. The existence of the deep value premium, the persistent, documented decades-long evidence that cheap stocks outperform expensive ones, is not a sign of a broken market. It is a sign of a healthy one, a market where the discomfort of human psychology creates persistent opportunity for the disciplined few who are willing to endure it. The market rewards patience, it rewards discipline, it rewards humility, and it rewards the willingness to be different, to hold what others sell, to buy what others fear. These are not exotic or difficult qualities to develop. They are qualities of character, and they are available to any investor who chooses to cultivate them. Conclusion. The gift of the acquirer's multiple. Tobias Carlisle closes this remarkable book by bringing everything back to its simplest, most essential form. The acquirer's multiple is, at its heart, one number: enterprise value divided by operating earnings. A single ratio that captures the total cost of owning a business relative to what that business actually earns from its operations. It is simpler than the magic formula. It is more accessible than the complex multi-factor models used by sophisticated quantitative hedge funds. It requires no proprietary data, no advanced mathematics, no special access to management teams or analyst networks. It requires only the willingness to look past the noise, past the headlines, past the emotional color that the market constantly splashes over every company it prices, and focus on the one thing that truly matters. How much are you paying relative to what you are getting? The billionaire contrarians, whose stories fill these pages, from the young Benjamin Graham hunting for cigar butts in the rubble of the 1930s, to Warren Buffett in his partnership years, relentlessly turning over every financial stone he could find, to Carl Icahn, writing his manifesto and preparing to shake the corporate world to its foundations, to David Einhorn and Dan Loeb, bringing deep value into the modern age. All of these extraordinary figures were, at their core, doing the same thing. They were finding businesses that were being offered to them at prices below what those businesses were worth. And they were having the patience, the courage, and the discipline to buy and hold until the market came to its senses. The acquirer's multiple is not a secret. It is not a shortcut. It does not promise instant wealth or effortless profits. What it promises is something more valuable and more durable: a systematic, evidence-based framework for making investment decisions that, over the long run, consistently generates superior returns for those who follow it with discipline and patience. The formula is available to anyone. The history is documented. The evidence is compelling. What separates the investor who captures these returns from the one who does not is not intelligence. It is not access. It is not luck. It is the willingness to be uncomfortable, to buy what others sell, to hold what others flee, and to trust a simple, elegant, powerful number over the noise of a market that will always find new ways to distract, alarm, and mislead the impatient and the undisciplined. That number is the acquirer's multiple. And if you have followed this journey from beginning to end, you now understand not just what it is and how to calculate it, but why it works, where it comes from, who has used it to build extraordinary wealth, and how you can use it to begin building your own. The formula is yours. The discipline and the patience are yours to develop. The returns over time are waiting.